Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Friday, interesting week.
We have a number of questions to get to today, so let's just dive right in. Gavin in Ireland says, "Hi, Bob. I'm a longtime student of Bob's commentary." So Professor Bob here.
Oh, we better drop over and have a pint.
A little Guinness never hurts.
Yeah.
Remember the billboards that said, "Drink Guinness, it's good for you."
Yes.
With the reckless actions of the Fed attempting to reinflate again, in turn destroying faith in the monetary system, how long historically has it taken to transition to a new sound reserve currency?
Oh, boy. Gavin, that's a good one. The best guess I have is that in a post-bubble contraction, which we're in, on previous ones, the senior currency used to be sterling and now it's the U.S. dollar, becomes chronically strong against most other currencies and most commodities. It's part of the post-bubble contraction. And the dollar has been firming in serious financial pressures. So you have two things going on. You've got the popular uprising whereby the public is acting against too much in your wallet and in your face government, and that is an attempt to reform the outrages of ambitious government. Then the other part of that is the public's going to demand a sound currency. And so I think the reform movement will extend into finances, and I think the Fed its powers of abuse will be trimmed, and I think we're going to end up with the U.S. dollar being the senior currency and at some point convertible into gold. So we're going to stay positive on the U.S. dollar, and despite the tremendous efforts taken by the Fed to depreciate it, don't think it's going to work.
Do you think gold mining companies are safe from desperate governments, in particular the Mexican government?
Oh, I can't comment on Mexico. No, I think ambitions are going to be subdued by popular uprisings and political reform, and eventually for the better, but it's going to be part of a post-bubble contraction whereby it's going to be difficult to make money in ordinary stock markets. It's going to be difficult to make money in yield instruments, high yield stuff, low quality. But the one thing that you can forecast in a post-bubble environment that will do well will be the gold stocks, mainly because the real price of gold goes up. So there are opportunities out there, but also there's some tremendous hazards.
And one final question from Gavin in Ireland. Has Bob still have plans for a book?
Oh, yes, I am. I'm actually going to do it. And Gavin, I will post your question up at my wall here as an inspiration.
From Mike, two questions. The first one, it feels like the other shoe is about to drop in the equities market. Can the recent lows in equities be broken, and how long in duration can this bear market extend? Oh,
yeah. A number of good performing stocks in some of the indexes are now overbought. Now, we've had a nice bounce. I guess it was a month ago when I came out with a piece called Let's Get a Bit Constructive or something like that. And then we've had a very good bounce. And all the way through, that tremendous washout has to be tested. It just has to be done. So whether the test will hold, I don't know, but our view on the overall stock market has been to sell the rallies and to avoid buying the dips. So here's another chance to lighten up on most equities.
And the second question for Mike. As of Monday, it looked like a triple top in the GDX year to date. Can we expect a retest of the lows in the gold miners and silver, assuming the second shoe drops in the overall equity market?
Yeah, you're right on with that one. We're getting technical excesses in some of the gold stocks as well on the upside here. So it looks like we could have a fairly broad decline for a few weeks in here. And I say, honestly, at this point, you don't know whether the previous washout low will hold. I would guess that it will, and then a bounce into mid-year. And then after mid-year, you start looking for seasonal weakness in industrial commodities, crude oil, and the market is just not going to take weakness in commodities. So there's trading opportunities if you're really good, but the best thing for people to do is just get defensive.
From Kate. Bob, as I watch this worldwide bear market unfold, I'm amazed how the U.S. tech stocks seem invincible, barely encountering a bump in the road. For example, as of Wednesday, Apple is down less than 3% year to date and still up 40% over the past year. Tesla up 74% year to year, up 170% over the year, over the past year. However, in the bear markets that commenced in 2000 and 2008, the high-flying tech stocks declined between 50 and 80%. So what accounts for these new high flyers?
They got lots of enthusiasm. Now, I looked at the chart of Apple and Tesla, and Tesla is a very unique promotion. You have to admire them. But Tesla is in a pattern from which it can fail. So, but hey, there's other more safer things to short. I mean, people love to short the big story, especially when it's as fake as Tesla is, but, it's dangerous because they have unbelievable power. But you had the 1929 crash down to a severe sellout in late October, then a rebound, and then the lows were tested in that November, and then you had a recovery. And then it's not widely known, but in 1930, the retail index reached new highs. So in a post-bubble environment, most anything can happen, and some of these tech stocks have been brilliant on rebounds, but I doubt that it'll hold. I think that we are now in a post-bubble contraction, and I also think that no amount of credit injection by the Fed will stave it off. All it does is make for wilder speculation.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, gasoline use in the U.S. down to a level it hasn't seen in 52 years. So we're going, what, just after the Korean War or something like that?
Yeah, the demand. So people are just not traveling.
Well, you're supposed
I know
to stay
I'm
home.
not, because, one, I don't have to go anywhere, and two, I don't feel like going anywhere. And it is happening, and this was generally across the states. And you've also had a sharp decline in the amount of trucking going on, and that's becoming difficult. So, but hopefully the truckers can keep going. But the flu disaster can't last forever. And at some point over the next few months, people just have to go back to work. And I'm saying this as an old-timer, who I'm very vulnerable to the flu, and that's why I'm staying careful. But for much younger people, it's a less risk. But I think it'll go away, and there will be a restoration of business activity. But you can't get over the fact that we are, I think, really in a post-bubble contraction that will last much longer than any of even this serious flu in duration. So, yeah, it's when you look at it that side, it's very difficult. But what we can do is just suggest to people is protect yourself in the financial markets as best possible.
Also, too, I'm thinking the NASDAQ has been doing, relatively well compared to the other equity markets. It deals with high tech, and there's all these companies working on either a COVID-19 cure, treatment, or vaccine. So are people kind of betting money that this company or that company might come up with the silver bullet?
Oh, yeah. You got that. Yeah. Yeah. The urge to speculate is always there until it gets absolutely runs out of winning games. And so we'll watch it. But the attempt by the Fed to restore the financial markets through injection of liquidity, I'm skeptical on that, mainly because the notion has been around for so long. There was a boom that ran until 1618. That's like, the early 1600s. And in London and Europe, there was a terrific crash because those markets were interlinked. And then an intellectual in England, Edward Misselden, he looked at the hardship of unemployment and said that something should be done, and then he imagined that you could bring credit from somewhere, and then it would make a credit contraction go away. And then in 1706, the banking promoter, John Law, observed the same thing, that all will be well if there's more money around. And, there was some guy in the 1800s, I forgot his name. Oh, yeah, and then in 1873, you had the highly esteemed editor of The Economist in London, Walter Bagehot, and he published a book called Lombard Street, which was about the financial markets. And in it, he said that a credit contraction was a form of neuralgia, and it could be eased by credit coming from somewhere, i.e. the Bank of England. And 1873 was the top of a bubble, and the contraction in England was so bad that by 1884, leading economists began calling it the Great Depression. And that Great Depression lasted till 1895, when then a long expansion started. And academic economists, as late as 1939, were still analyzing the Great Depression, the 1873 to 1895 one, on how it could have been prevented or ameliorated or whatever. And then all of a sudden, 1939, we've got a real depression now. So economists really are a hopeless bunch. But the main thing is, and then, of course, in the 1930s contraction, Keynes came up with the same idea that, we have a credit contraction. And also he was surprised by it because he had been investing and making some money on his own account, but then he got hit by the 1929 crash. But then that's where he came out with the liquidity preference thing. And again, the same idea that, credit contraction's awful. we can get credit from somewhere to make the credit contraction go away, but they don't seem to understand that a credit contraction follows a huge credit expansion, just as sure as night follows day. So what we're seeing here, the credit contraction is underway. You've had credit spreads widening, so people are fearful of quality. And then you've also had the action in the yield curve, which is the difference between long-dated and short-dated interest rates. And it does a certain pattern. When in a boom, short rates will rise above long rates, and that's called an inversion. And the curve inverted last summer, which is the warning, because on our chart back to 1857, every inversion of the curve has been followed by a recession. So then there's even more to this, Jim, that then in December, the curve inverted again. So you had a double top in inversion. And the last time we had that was in 2007. And the last time, and before that, there was a double inversion in 1929. We all know that date. And then the one before that was in the 1873 bubble. So once you have that action, a recession has followed. So it's going to be interesting, but I think that the public will begin to see through all the experts and their central banking and manipulations of interest rates and manipulation of currencies. And they will have had enough of it and say, hey, you guys, we're going to reform you. It's going to be very unpopular, but it's be fun to watch, Jim.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline that caught your attention today. Wall Street feasts on federal virus aid as Main Street starves. What does that mean?
Isn't it the way?
Yeah.
In a new financial era, everything is financial, and it goes through the financial markets, and that means New York or London or wherever. And so they're going to ease. And how do they do that? They inject credit into the financial markets, and that goes through your big dealers in New York and elsewhere. And it's done immediately, whereas just writing the checks to millions of people or small businesses, how fast can they get that going? It's most difficult. So once again, Wall Street will benefit, and the help will have a difficult time getting to Main Street. And it's just the way it works. It's sad to see, because there's certainly many legit businesses there that just can't take a couple of months of no revenues coming in at all. And then on the other hand, you've got the real estate people who own, let's say, retail outlets on various shopping streets. Then all of a sudden, they don't have their rentals being paid. This is really serious stuff. And I hope the coronavirus eases, and then that will help get some people back to business. But on the other hand, we're dealing with a post-bubble contraction, and I think it'll overwhelm the central bank's attempt to reflate everything. They've tried in the past and it hasn't worked.
Also, if you don't look after the little person, the average consumer, isn't something like 72% of the U.S. economy driven by the consumer?
Oh, yeah. I think that 70% number is valid, that it all comes to the consumer. And also, you go back in economic history and you got Say's law that in order to consume, you have to produce. And you've got to have people at work in whatever they do. And while it's risky now, perhaps the risk from the virus is over time will diminish. Well, it will. We know that they have in the past. But this has been extraordinary when you have had the market would have sold off anyways because the excesses in December, January were so terrific. And there's actually, I think it was January 3rd when I wrote that more than likely the stock market will sell off. And then eventually the media will come up with the reason for the sell-off. But you couldn't determine the reason ahead of time. And it turns out to be the contagion. But it would have sold off anyways. But what this has done, and governments moving immediately to shut down movement of people, is extraordinary. But I looked it up, Jim, and in the 1664 in London, it was a fairly thriving financial market then. The main market was in Amsterdam. But at any rate, in London, all of a sudden you had a threat of a war with Holland, boom, hit the markets. Then in 1865, you had the Black Death hit Northern Europe and London, and the die-off in London was about 20% on the Black Death. So you can imagine what it did to the markets. And then they were getting over that the next year, 1666, when all of a sudden you had that huge London fire. And of 80,000 residents, let's see, put it this way, 70,000 people out of 80,000 were without accommodation. So you want to talk about misery events then. Threat of war in 1664, actual Black Death in 1665, and then a good portion of London was burned in 1666. So far, I think we're looking on much better than they were then.
Bob, thank you so much for chatting with us and for answering all those listener questions.
Good to be with you, Jim, and look forward to next week.
If you have any questions for Bob, you can send them to info@HoweStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.